Howdy, Jacob here. Today we're looking at the next company in our dividend yield screener with ticker symbol KAMN. So first things first, roughly $700 million market cap, over $1 billion enterprise value. So a little bit of net debt there, 3.4% on the dividend yield screener, or the dividend yield is 3.4%. Looks like between 2021 and 2022 increase a lot in long-term debt from 189 million to 561 million. I presume that was an acquisition, and it was. So $450 million acquisition. Looks like they went in debt 363 million to help fund that. So this is an interesting business. If we look at free cash flow here, so the last 4 years averages out to zero because we have negative 30 million, zero, 30 million, positive, zero, essentially. But if we look elsewhere, we're looking at 2018, 140 million here, 62 million here, 78 million. So this is going to be a company you're going to have to figure out, are they going to get back to these type of numbers? It looks like in the rolling 12 months, we're looking at about 58 million in free cash flow, which is still roughly 10 times their long-term debt. So you don't like to see that. And they don't have any cash on hand to help fund that. So it's not what you want to see. It looks like that debt is going to be sticking around for a little bit at least. It's tough here because if you look at a 5-year average, you're looking at four values that average out to zero, and then 140 million divided by five, you're looking at almost 30 million. So technically, they can afford a dividend that's like this, but for me, I would say they'd probably cut the dividend in half, pay out 10 million, even in the cyclical appearance of the numbers, they could still afford it. Um, it's just tough because this will be a business I want to look at to see what were these acquisitions, and I might want to give myself a couple of years to see how the acquisitions play out if I don't have the actual data, the past data for these acquisitions. But for now, I think we can start setting us some assumptions. So for the dividend, I think cutting that in half should be fine. And then on the revenue side, I don't know, zero. I don't know how it was 1.6 billion over here and now it's 688 million, and it doesn't look like it was a devastation. Looks like they haven't unacquired anything, so that's interesting. But I'm going to do 0%, 10 on the P, price free cash flow. And then as for margins, it's all over the place. Maybe I'll do 6 and 12 or something. No share change. Yeah, this is saying it's going to have to fall 60% to get to a 15% return. The business is all over the place. I don't feel comfortable with these assumptions because I don't know what the business is going to look like, given that the last 4 years is nothing, and then over here there's large cash flows. So, if they can get back to 100 mil a year in free cash flow, then it's a pretty cheap price. You're looking at 6.6 times that market cap for that right now. But for me, it's just whether they can do that, and I'm uncomfortable with having 561 million long-term debt with only 24 million in cash and cash equivalents, and they produce no cash for 4 years. Again, I see that they have 58 million in the rolling 12, but that's 58 million. That 58 million is still pretty much 10 times their long-term debt. And so if they're paying out this dividend, they're going to have to use the excess free cash flow beyond free cash flow minus dividend to help fund that, or pay down some of that debt. And it looks like they're also really good at making these huge acquisitions every couple of years, which means that they'll probably just have to either pound some cash or go into debt more. And so for right now, I think I'm fine waiting quite a bit of time before it gets to something I'm going to do a deeper dive on. And I hope everyone enjoyed the company that we looked at today and has a good rest of their day. Thank you.